Hi, in this video we'll be looking at the Accruals Principle, and we may also see this called the Accruals Concept or Accrual Accounting, and this is also very interlinked with, say, the Matching Principle and Concept and the Revenue Recognition Principle. Now, this may be used interchangeably with, say, the Matching Concept or the Matching Principle, and it's very similar to the revenue recognition principle. These aren't actually exactly the same concepts, and accruals accounting uses the matching principle, and we combine this to get the revenue recognition principle. But I won't go into detail on that. That's a subject for another video, as these are separate concepts, but they are very, very similar. And if you can understand the accruals principle, these other concepts will almost seem like the exact same thing. So what does the accruals principle actually tell us? Well, it is a principle that says that, as this bullet point says here, that transactions should be recorded in the time period in which they occur, regardless of when the actual cash flows for the transaction were received. And the reason behind this is because it provides a more accurate picture of the actual financial position of a business. So if we look in a bit more detail and try to think of what this actually means, so let's consider that we have some sort of business transaction, and the most obvious one of these business transactions may be that a business makes a sale. And let's say we sell some goods for £100 in, let's say, the 30th of June. 30th of June. So what the accruals principle says is that this transaction, this sale, should be recorded in the time period in which the sale occurs, i.e. on the 30th of June. And this is regardless of when the actual cash flows for the transaction were received. So if we were on the 30th of June to make a sale and we received £100 for whatever good we sold, obviously we would expect to record this on our accounts on the 30th of June. But let's consider instead that this customer, instead of paying on the day on the 30th of June, we gave them, say, a month to make the payment, and they may actually pay for the good on the 30th of July. Or, say, even more out there, we could give them a whole year to pay this off, and they could pay on the 30th of June in the next year. What the accruals principle is saying is that this doesn't actually matter for our account. No matter when we actually receive this money, no matter when the actual cash flows are received, it doesn't matter. Our actual transaction is going to be recorded on the 30th of June, which is when the transaction occurred, when this person agreed to pay us this £100, because it doesn't matter when we're going to receive it. The point is that we will receive it. So this is going to be a factor in the actual financial position of our business. So we record it when the transaction occurs, when we make the sale, not when we receive the cash. So the purpose of this accruals principle is that we're matching income against expenses when the transaction occurs, rather than just when the cash changes hands. So we want to match, and this is why it's linked into the matching principle, as we may call it. We're matching income against expenses. We're going to incur an expense or a cost in sort of the production of whatever this good was that we sold for £100, and we want to match the cost of producing this good to the income from selling this good. And so this is a key concept in our accounts, because the reason we're incurring this cost is to receive this income. So we want to match these together so that we can actually figure out how well our business is performing. Is our income greater than our costs? And so are we going to make a profit is a key thing to consider when you're a business. So that's what the accruals principle is trying to get at. So we won't go in much more detail than that. That's just a basic introduction to the accruals principle. And we just need to remember this. This will be a good definition to remember. It may on its own not make a whole lot of sense just when you read through it for the first time. But if you can remember those words, and then sort of hopefully we've been able to get a bit more intuition with our very simple example here. So that will wrap up this video. If it was at all useful, please do leave a like rating. That will be really helpful for me. Make sure to check out the accounting playlist for more videos like this one, and of course to subscribe to add some econ to your subscription feed.